Here's something most retirees never find out until they're already in retirement. The way your portfolio is structured right now, not what's in it, but where each investment sits, could be costing you $10,000 to $30,000 every single year in taxes you were never required to pay. Not because you made bad investments, not because you chose the wrong funds, because nobody ever told you that where you hold your investments matters just as much as what you hold. There is a name for this concept. It's called asset location, and according to research from Charles Schwab, optimizing it can reduce your tax drag by $2,800 to $8,200 per year, even on a $2 million portfolio. Over 20 years, that compounds to more than $200,000 in after-tax wealth, gone because of an organizational mistake. Now here's where it gets interesting. T. Rowe Price tested thousands of withdrawal strategies across portfolios ranging from $600,000 to $2.5 million. Their research found that retirees who structured their withdrawals the right way, not just what they withdrew, but the order they withdrew it, saved $35,000 in federal taxes and left $106,000 more to their heirs in a single modeled case. That's not a 30-year return. That's a structural difference in how a portfolio is organized. And most advisors never bring this up. In the next 17 minutes, I want to walk you through 4 things. Number 1, why the order you withdraw money is more important than most people realize. Number 2, the asset location mistake almost every retiree makes without knowing it. Number 3, the IRMAA trap that is quietly adding thousands to your Medicare bill. And number 4, 3 specific steps you can take this week to fix all of this before the damage gets worse. Section 1. The withdrawal order problem and why taxable first is wrong. Most people in retirement follow the same piece of advice. Draw from your taxable brokerage account first. Let the IRA and Roth accounts keep growing. Save the Roth for last. It sounds logical, but in practice, it quietly hands a larger tax bill to millions of retirees every year. Here is why. Imagine a couple, both 65 years old. They have $900,000 in a traditional IRA, $200,000 in a Roth IRA, and $400,000 in a taxable brokerage account. They need $80,000 per year to live on. Following conventional wisdom, they spend down the taxable account first. They live off of it for about 5 years. That part feels fine. But then something happens. They reach age 73. At that point, the IRS requires something called an RMD, Required Minimum Distribution. The IRS now forces you to take withdrawals from your traditional IRA, whether you need the money or not. And because they ignored that $900,000 IRA for 8 years and let it keep growing, the balance has now climbed closer to $1.3 million. Their first RMD could be over $47,000, taxable income they never chose to take. And because their Social Security is now fully in play, and Social Security becomes up to 85% taxable once combined income exceeds $44,000 for a married couple, they are suddenly looking at a tax bracket they never expected. Here's what T. Rowe Price found when they modeled this exact scenario. A couple with $2.5 million who followed the conventional withdrawal order, taxable first, IRA second, Roth last, paid significantly more in taxes in their 70s and 80s than a couple who took modest IRA distributions in their early retirement years at 62 and 63, before RMDs started, before Social Security fully kicked in, before the tax brackets got compressed. The second couple paid a bit more in their early 60s. They paid far less overall, and the portfolio lasted longer. The Journal of Accountancy modeled a similar scenario and found a lifetime tax savings of $124,144, with the portfolio projecting $655,791 higher in value at age 100. Let me say that again. $655,791 higher. Same income, same investment returns, different withdrawal order. This is the mistake that nobody in HR will explain to you and that most advisors don't bring up because it doesn't generate a commission. Before we continue, please show some free love and support by hitting the like button and let me know your opinion, thoughts, or any questions if you have. I reply every single comment and I would be very happy to help because this channel is built specifically to help retirees. Now, let's move on. Section 2. The asset location mistake and the $200,000 invisible cost. Now let's talk about where your investments are sitting. When you have multiple account types, a traditional IRA, a Roth IRA, and a regular brokerage account, every dollar you own lives in one of three tax buckets. Bucket 1, tax deferred, your traditional 401k, your traditional IRA. You contributed pre-tax, it grows tax deferred, but every dollar you take out gets taxed as ordinary income. At the 22% bracket, a $100,000 withdrawal means $22,000 goes to the IRS. Bucket 2, tax-free, your Roth IRA, your Roth 401k. You paid taxes going in, now it grows tax-free. Qualified withdrawals come out completely tax-free, no taxes. No RMDs either. Your Roth is never touched by the IRS unless you pass it on to non-spousal heirs, who then have 10 years to distribute it. Bucket 3, taxable, your regular brokerage account. You pay taxes on dividends and capital gains each year, even if you don't sell anything. Now here's the question most people never think to ask. Does it matter which investments go in which bucket? It matters enormously. Let me give you a specific example because this is where it becomes real. You own a bond fund. Let's say it earns 5% per year in interest. If you hold that bond fund in your taxable brokerage account, that 5% interest gets taxed every year as ordinary income. At the 22% bracket, you're paying the IRS 1.1 percentage points of your return annually, every year, whether you want to or not. Now put that same bond fund inside your traditional IRA. That 5% interest compounds without any annual tax drag. You only pay when you take the money out, and by then you may be in a lower bracket. Fidelity ran this comparison and found that placing a bond fund in a Roth IRA versus a taxable account produced a difference of nearly $270,000 in after-tax value over 20 years for an investor in the 35% bracket. Charles Schwab's research found that even for moderate investors, not high income, not $5 million portfolios, proper asset location can boost annual after-tax returns by 0.14 to 0.41 percentage points. That sounds small, but on a $1 million portfolio, that's $1,400 to $4,100 extra per year, every year, with no change to your investments at all. Here's the simple version. Your tax-deferred IRA or 401k. That's where you want bonds, REITs, anything that generates regular taxable income. Because inside an IRA, that income doesn't get taxed until you pull it out. Your Roth IRA, that's where you want your highest growth assets. Index funds tracking the S&P 500, international equity funds, small cap growth funds, because the Roth turns all of that growth permanently tax-free. And unlike a traditional IRA, the Roth is never subject to RMDs. Every dollar that compounds in a Roth can stay there for your lifetime. Your taxable brokerage, that's where you park your most tax-efficient assets. Broad market index ETFs with low turnover, municipal bonds if you're in a higher bracket, because municipal bond interest is federally tax-free. long-term buy and hold stock positions where you control when the taxable event happens. Now, before we get to the most important section, and there's a number in it that surprises most people, I want to make sure one thing is clear. Everything I've covered so far, the withdrawal order, the asset location, is essentially about managing the taxes you know you have to pay. But there is a third category of taxes in retirement, one that feels like something else entirely. It's not labeled as a tax, it doesn't come from the IRS, it shows up on your Medicare bill. And because it's based on your income from 2 years ago, by the time most retirees find out about it, it's already too late to do anything about it. It's called IRMAA, and it could be adding $3,000, $5,000, or even $10,000 per year to your Medicare costs right now. Section 3, the IRMAA trap, the hidden Medicare tax most retirees never see coming. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge, an extra premium on top of your standard Medicare Part B and Part D costs that kicks in when your income exceeds certain thresholds. In 2026, those thresholds are $109,000 for single filers and $218,000 for married couples filing jointly. Now, you might be thinking, I'm not making $218,000. This doesn't apply to me. Stay with me, because here's where it catches people off guard. IRMAA doesn't measure your income this year. It measures your income from 2 years ago. Your 2024 tax return is what determines your 2026 Medicare premiums. Think about what that means. If you retired in 2024 and you had a full year of salary income on your 2024 return, Medicare looked at that number. Even if your 2025 income dropped to $40,000 in retirement, you're paying 2026 premiums based on 2024's number. And the standard Medicare Part B premium in 2026 is $202.90 per month. If IRMAA kicks in, a married couple can jump to $284.10 per person per month at the first tier, all the way to $689.90 per person per month at the highest tier. That's $8,079 to $16,558 per year per couple just for Medicare, on top of regular premiums. And here's the detail that makes this especially painful. IRMAA is not a gradual increase. It works like a cliff. If your income goes $1 over the first threshold, you owe the full surcharge for that tier, not a percentage of the difference. Just $1 over the $218,000 line as a married couple, and your Medicare bill jumps by more than $1,000 per year per person. Imagine a recently retired couple, both age 66. Their retirement income is $215,000 in most years, but in 2024, they took a large IRA distribution to pay off their mortgage. That single distribution pushed their modified adjusted gross income to $225,000, just $7,000 over the first IRMAA threshold. Because of that one decision, their 2026 Medicare premiums jumped by over $2,500 per couple. And it's not a one-time cost. It lasts for the full year. Now here's the connection back to everything we talked about earlier. The withdrawals from your traditional IRA, they count toward IRMAA income. The RMDs you're forced to take at age 73, they count. Roth conversions you did, they count in the year you did them. Even municipal bond interest gets added back into your MAGI for IRMAA purposes. But qualified Roth IRA withdrawals do not count. This is why a Roth IRA is one of the most powerful tools in retirement, not just because withdrawals are tax-free, but because they don't increase your Medicare premiums. And as of 2026, you can also appeal IRMAA using Form SSA 44 if you've had a qualifying life event, retirement, loss of income, death of a spouse. Most retirees don't know this form exists. The Social Security Administration's approval rate for legitimate qualifying events is high, and it can eliminate 1 year of surcharges immediately. Here's the thing I want you to understand. This is not complicated. It doesn't require a financial advisor, though a fee-only CPA can make a big difference here. What it requires is knowing what to look for. So here are 3 specific things I want you to do in the next 7 days. Step 1. Pull up your account statements. List every account you own and what's inside each one. Traditional IRA, Roth IRA, brokerage account, any old 401k. Write down for each account what percentage is in bonds or bond funds, what percentage is in stock funds, and what type of account holds each. If you find bonds in a taxable brokerage account while you still have room in your IRA, that's the first thing to rebalance when you do your next annual review. Step 2. Go to ssa.gov and pull up your Social Security statement. Look at your estimated benefit at age 62, 66, or your full retirement age, and 70. Now think about what your income will look like in the gap years between when you retire and when you claim Social Security, or between when you retire and when your RMDs start at age 73. That gap is your window. That's the period where modest Roth conversions, done carefully, staying within your current tax bracket, can reduce the size of your future RMDs and protect you from the IRMAA cliff. In 2025, the 22% bracket for married couples runs from $94,301 to $201,050 in taxable income. Filling that bracket with Roth conversions today locks in a known tax rate and protects future income from being taxed at potentially higher rates. Step 3. Look at your 2024 tax return, the one you filed in 2025. Find your modified adjusted gross income. If you're within $20,000 of the IRMAA threshold, $218,000 for a married couple, flag it. One large IRA distribution, one home sale, or one unplanned conversion could push you over. Knowing where you sit gives you time to plan around it. Before you go, I want to hear from you. Do you currently have all 3 account types? A traditional IRA, a Roth, and a taxable brokerage account? Or are most of your savings in one type? Drop it in the comments below. Tell me your situation. I read every single comment, and I'll try to give you a more specific answer based on what you share. And if you want to know about the mistakes that 74% of retirees make in retirement, that video is right here. Thanks for watching, and I will see you in the next one.